Welcome to the May edition of This Month in Payroll for 2026. I'm Alana Hayduck, a partner in PwC's payroll advisory practice. This month, we will focus on year-end due dates, tax rate and threshold changes, and total remuneration and Payday Super. Let's begin with year-end due dates. As year-end approaches, understanding the key payroll deadlines will help you plan resources and manage compliance effectively. Fringe benefits tax returns for the year ended 31 March 2026 are due for lodgement and payment on 21 May 2026 or an extended due date to 25 June if you use a tax agent. You should ensure that you complete your final pay runs by 30 June and lodge all STP event reports. Don't forget, Payday Super commences on the 1st of July 2026, requiring an employer to report qualifying earnings, and all contributions are to be received by the Employees Fund within 7 business days. STP finalisation declarations and PAYG payment summaries for a non-STP reporter, for example, an employer who has a withholding payer number, are due on the 14th of July. Employee share scheme statements are also due on the 14th of July to the employee, with the Employee Share Scheme Annual Report due to the ATO by the 14th of August. Annual payroll tax reconciliations for Queensland, Victoria, Western Australia, Tasmania and Northern Territory are due by the 21st of July. Reconciliations for New South Wales, ACT and South Australia are due on the 28th of July. Superannuation guarantee for the quarter ending 30 June is due on the 21st of July, and that will be the last one that can be paid quarterly. Taxable payments annual report for contractor payments for businesses in building and construction, cleaning, courier, road freight, IT, and security surveillance services is due on the 28th of August. And a final reminder that due dates for workers' compensation declarations vary by state or territory regulator, but are typically due in late August to early October. Please note that some of these dates may be adjusted by the regulatory authorities, in particular the annual payroll tax return due dates. We recommend that you check each due date as year-end approaches. Now let's turn to our second topic of tax rates and threshold changes for the new tax year. There was a lot of discussion last week about the federal budget announcements to negative gearing and capital gains tax. However, several changes affecting payroll and taxes are set to take effect on the 1st of July. Let's explore these changes. There are personal income tax changes which will result in the issuance of new pay-as-you-go withholding tables. The lowest marginal rate that applies to taxable income between $18,201 and $45,000 will be reduced in 2 stages. Firstly, from 16% to 15% for the 26-27 income year, and from 15% to 14% for the 27-28 income year. All other brackets are expected to remain unchanged. The SG rate reached its final legislated rate of 12% on the 1st of July 2025 and is not scheduled to change. There are, however, changes to the maximum contributions base, or the MCB. From the 1st of July, under the Payday Super regime, the MCB is calculated annually using a formula. For 2026-27, the MCB will be $270,830 per annum, which replaces the quarterly equivalent from this year. The concessional contributions cap will be increased to $32,500, which has been indexed from $30,000 this year. The tax-free limit for a genuine redundancy payment is calculated using a legislated formula and is indexed annually on the 1st of July. The base amount for 2026-27 is $13,598 and the service amount is $6,801. The employment termination payment, or ETP cap, which applies to the taxable component of an ETP, including the portion of a genuine redundancy payment in excess of the tax-free limit, will also be indexed. For the 2026-27 year, it will be to $170,000. The whole of income cap is not indexed and will remain the same at $180,000. You should ensure that your payroll software is updated for these changes and that you have instructions from your software vendor as to any actions you are required to make in the system before you commence your July payrolls. Now our final topic of total remuneration and Payday Super. As we've said, Payday Super commences on the 1st of July 2026. Where you operate a total remuneration reward structure, there are challenges for your payroll team. For many employment arrangements, employees are provided a total remuneration package, which is made up of the employee's base salary and the employer's compulsory super guarantee contributions in respect of that salary. The base salary refers to the fixed pre-tax amount an individual earns for the work they perform. The superannuation component is a legally mandated contribution made by the employer into the employee's chosen fund. Under the current superannuation guarantee regime, employers determine the employee's base salary by separating out the superannuation guarantee component from the total remuneration. If an employee is under the maximum contributions base, or MCB, which is currently $250,000, the base salary is calculated by dividing the total remuneration by 1.12, which reflects the current superannuation guarantee rate of 12%. For example, if an employee's total remuneration is $150,000, the base salary component is $133,928.57, and the superannuation component is $16,071.43. These payments are usually distributed evenly across each pay period throughout the year. If an employee is over the MCB, the employer can calculate the base salary by deducting the concessional contributions cap, which is currently $30,000. The employer then pays superannuation either evenly over each quarter or at a rate of 12% of the base salary up to the quarterly cap. As an example, with a total remuneration of $300,000, the base salary is $270,000 and the superannuation component is $30,000. If the employee is paid monthly, the employer can pay superannuation either evenly each month at $2,500 per month or at a rate of 12% capped at the quarterly MCB, which would mean $2,700 for the first 2 months of each quarter and $2,100 for the third month. Payday superannuation introduces new complexities to payroll processing for total remuneration packages. Under the new rules, employers must pay the superannuation guarantee on qualifying earnings up to the MCB, assessed as an annual cap rather than the quarterly one we have now. When an employee is under the MCB, the split between base salary and superannuation remains unchanged from the previous practice. However, difficulties arise when an employee receives additional variable remuneration, such as bonuses, commissions, or back pay, that push their earnings over the MCB. In such cases, the employer may need to make a total remuneration adjustment. For instance, if the employer pays a base salary of $133,928.57 plus superannuation of $16,071.43 and then awards a superannuation inclusive bonus of $100,000 in September, the employer must deduct superannuation from the bonus. If the base salary plus the superannuation exclusive bonus is less than the annual MCB, no adjustment to total remuneration is required. Let's look at another example. If the employer provides a base salary of $270,000 plus superannuation of $30,000 and then gives a superannuation inclusive bonus of $100,000 in September, the employer will need to adjust the base salary to ensure the correct total remuneration is paid for the rest of the year. The bonus counts as qualified earnings, and since the MCB is calculated annually, the superannuation on the bonus will result in the employee reaching the MCB earlier in the year. This necessitates an adjustment to the base salary for the remainder of the year to ensure that the total remuneration is paid. An additional issue can arise if the employee terminates their employment, as more total remuneration may have been paid under this methodology. Given these challenges, employers who compensate employees via total remuneration arrangements should consider recalculating the base salary as total remuneration less superannuation uncapped to the MCB and pay a total remuneration adjustment as necessary. For example, if an employer divides the total remuneration of $300,000 into a base salary of $267,857.14 and superannuation of $32,142.86, and the employee's superannuation is capped at $30,000, the employer will need to adjust the base salary to ensure the total remuneration is paid accurately. This method will ensure the employee is not overpaid if they terminate employment. The management of total remuneration and superannuation will require an outside of the payroll software monitoring to ensure the correct superannuation and total remuneration is paid. Where you operate a total remuneration reward structure, we would recommend you review your employment contracts and reward policy to determine the impact of the Payday Super legislation and discuss the impact with your employment lawyers and payroll team. And that's it for our May edition of This Month in Payroll. If you would like to revisit any of our prior updates, they are available on our website at pwc.com.au/payroll. And if you have any questions or need support, please reach out to myself or your usual PwC contact. Until next time, have a great month in payroll.